Hello from Trend Signal for our review of the data and events of the week beginning the 18th of April. We start the week with news overnight. In fact, the market's dominated by this news following the producers' meeting in Doha. Very much a risk-off move. First thing Monday morning, equities down, oil sector falling actually, and the rest of the resource sector falling in sympathy. But equities bouncing a little bit from the initial sell-off, and we're waiting to see exactly how the US react to the news come Monday lunchtime. But certainly the likes of BP, Shell all down 2.5, miners off between 1.5% and 3%, and as expected, the Canadian, Aussie, and New Zealand currencies, the resource currencies, hit as well. Effectively, the negotiations between the 16 oil producers in Doha ended without any agreement on limiting supplies, and we're seeing the knee-jerk reaction in oil prices. The actual summit dragged on for at least 10 hours longer than its scheduled finish time with no agreement. And the agreement really sort of failed after the Saudis said they wouldn't agree to any production freeze unless it included Iran. And as Iran is not present at the meeting, it was highly unlikely to fail, highly unlikely to succeed, I should say. I think part of the problem is that OPEC members don't really trust each other, and Iran has only just started exporting crude, so obviously it refuses to be part of any deal, and probably quite rightly so. And I think Saudi knows that if it scales back its production in any way, then other producers just step in and take their market share. So there we have it, and that's the backdrop to the start of the week, really. Last week, equities had a reasonably good week, certainly in the first 3 days last week, flatlined a little bit Thursday, Friday ahead of this Doha meeting. But we start the week in that frame, really. The calendar this week is fairly light. The highlight is undoubtedly the ECB monthly policy meeting and the Philly Fed manufacturing index on Thursday. And I think it's this debate rages on about how effective the negative interest rate policy is. An article in the Sunday Times business section tried to explain the surreal world of negative interest rates and how normal rails are flipped on their head. Confusing to many, but potentially, deadly, but certainly very destructive to some of the weaker Eurozone banks. In Japan and Eurozone, where rates are negative, both the Japanese yen and the euro have rallied since their respective central banks introduced further cuts into negative territory. So this isn't really what Mario Draghi at the ECB or Kuroda at the BOJ wanted, which really brings us onto the ECB meeting this Thursday. Draghi and his governing council may wish to talk the euro down again, but we don't expect any action from the ECB. They just cut rates deeper into negative territory last month, and they extended QE at the last meeting as well. So I think it's just talk, really, than any particular action that we expect there. In fact, the last month's move on the euro, in fact, the close certainly in March was the highest since December 2014, which is extraordinary, really. But the Eurozone, I think, suffers from a strong northern base with a patchy, weaker southern sector. And I think thereby hangs the tail. I think certainly Germany are happy with a stronger euro, but certainly not in the southern sector, as it were. And deflation obviously is a major issue across all Eurozone countries, and particularly poignant in the likes of Spain, where prices are falling at 0.7% on the year. But it's the worst, but not alone, of course. So negative interest rates and a sizable increase in QE have not done what Draghi and his council wanted, certainly at least not to the euro anyway. But of course, the euro path doesn't just depend on Eurozone policy, it depends on US monetary policy, Brexit, which is something that seems to dominate most discussion, certainly here in the UK and to an increasing extent in Europe as well. For now, the risk regarding the euro seems to be, still on the upside, with potential for a further squeeze higher. So, before we have the ECB's monthly policy meeting, we've got the German ZEW Economic Sentiment Indicator on Tuesday, an improvement in the markets generally and a recovery from the January angst. The business sentiment is expected to improve further to 8.2 from 4.3 last month. Tuesday afternoon, we've got a whole host of central bankers talking in order of appearance. Reserve Bank of Australia, followed by our Mark Carney from the Bank of England, and then the Bank of Canada's POLs, and those have the potential to affect those particular currencies. So the Aussie dollar, the British pound, and the Canadian dollar all will be sensitive to those particular speeches. But of course, Brexit woes ebb and flow from virtually every news announcement, etc. So that'll continue to be in the headlines right up until polling day. Other than that, the key release is the Fully Fed Manufacturing Index on Thursday, where we expect a downtick from last month's very strong number. Still okay though, 8.1. That's it. Thank you very much for listening. Bye for now.
If you would like more information about trading the right way, Trend Signal is giving you the opportunity to see and hear about its services live at a free online seminar. Take a look at the Trend Signal website for the latest events and to book your free place.